what went mostly unnoticed in the last decade and then came back with a vengeance? Inflation. The Fed has an inflation target of 2% per year, right? So on that note, actually, I want to share an interesting perspective on inflation being a good thing from my friend Nick Majuli. He writes, no currency should be able to buy the same basket of goods over very long time spans through hoarding. If you want to retain the purchasing power of your money, it should participate in society via investment. I had never heard this perspective before, so I thought it was worth sharing. But anyway, BlackRock is predicting further easing of supply chain constraints, which would push the cost of goods down, but crucially, they are not expecting us next year to return back to that pre-pandemic level of inflation. They write, given our view of higher inflation and stable rates in the months ahead, allocation to tips can be a hedge against inflation. So what does this mean for you? I asked Christy to break this down for us.
It's one of the more complicated areas of the financial markets, just to understand, because the mechanics of it really matter. So Treasury inflation-protected securities are bonds that the US government issues. And what happens is that the value of par, so the amount that you get back at the end of that bond, adjusts up and down with inflation, or just adjusts up with inflation. There's a TIPS ETF, and it has the great ticker of just being TIPS. So it's very easy to find. So what that really means is that the opportunity and the time when you would want to think about buying a TIPS is if expectations in the market for inflation are lower than they end up actually being. So if you think that the market is pricing a really rapid return to low or 0 or 2% inflation, then you wouldn't want to hold TIPS. If you think that the market underappreciates the inflation that's coming ahead of us, TIPS would outperform regular bonds. So the value of them would tick higher as inflation does. So they really do move in lockstep with inflation. So we would call that an explicit inflation hedge. Also kind of within that bucket and within that theme of thinking about inflation and sort of living with it for longer, there's other ways to position a portfolio for that as well.
The report states that the other element to consider is infrastructure spending. The Infrastructure and Jobs Act directed $1.2 trillion to U.S. infrastructure spending, comprising some 4,300 projects in 2023.
Historically, if we look at sort of the performance in different periods of higher inflation, infrastructure stocks tend to perform better than the overall stock market. So it's an area of opportunity. Part of that is because some of those longer term contracts within utilities and with other infrastructure projects have built-in mechanisms so that when inflation is higher over the course of the 10 or 20 years that project is underway, the pricing actually ticks higher. So they have sort of this implicit inflation hedge in them as well. And then also on the infrastructure stocks front, not only would it benefit from higher than currently expected inflation, which is our view and our base case that the market is overly optimistic that inflation is going away soon. It seems like we cannot get away from that transitory narrative. I think outside of that, there are other tailwinds for infrastructure as well. And a lot of that is just politics and spending. So if you look at the Inflation Reduction Act, there's millions and millions of dollars that are allocated to infrastructure projects. So some of those infrastructure stocks should benefit as well.